Welcome to the Utilization of Money podcast with Todd Levine from Levine Financial Group. In this podcast, we teach our clients how to own their personal economy. Join us on this journey where we build upon your greatest asset as Todd draws from his years of expertise, solutions, strategies, and expert guest stories to help you understand how money works.
Hello and welcome to Utilization of Money with Todd Levine from Levine Financial Group. Today we're doing a part 2 of a 2-part podcast. On the last podcast, Todd really dove deep into whole life insurance and really explained what it is, how whole life can be an asset. He touched on what's called the gift of a lifetime and really kind of touched on some estate planning options with whole life insurance. Now, it was very, very robust. There was a ton of information given. It was like eating steak. It was really, you're chewing and chewing and chewing on this stuff. If you haven't heard that podcast, please go back and listen to it because it matches this podcast perfectly. What's going to happen now is Todd is going to tell us some examples of how different clients have utilized whole life insurance. Most people think of whole life insurance or life insurance in general as I buy a policy, when I die, my family gets the money. There are a ton of other ways to utilize the assets and to utilize the money that you're involving in this policy. So I'm really excited to get started with this. Todd, thank you so much for doing this part 2 because I want to see some real life examples here.
Nice to be back, Eric. I'm excited to be able to continue on really doing a deep dive into what we feel is a really important vehicle to have in your financial world, which is whole life insurance, amongst other things. But today, what we want to try to do is really just show some areas in which our clients can utilize this vehicle. And I think it's definitely misunderstood where most people think that life insurance is just life insurance and, it's just a pure protection play and they're going to put it in place and then it's going to pay out to somebody when they die. But as we talked about in our previous podcast, that there's so many other ways we can utilize this vehicle, and we're going to go into that today. So I identified 5 different areas that our clients actually utilize these vehicles pretty frequently. Now, there's probably more, but I felt that it would be nice to kind of talk about real life scenarios that have happened with our clients that will really give the audience listening a good idea on how diverse this asset can be. All
right, that sounds great to me. Where do we start?
Yeah, actually. So the top 5, I'll just name them off real quick, and then I'll go through each one individually. The top 5 I identified were utilizing this vehicle to buy a home and or an investment property, utilizing it for college planning,
Okay.
In a more emergency type of situation, utilizing it to help bridge in scenarios like losing a job. Estate planning scenarios, gifting. In this podcast, I'm going to talk about a gifting scenario. And then one of my clients utilizing it to buy a business. So the first one was really, the first one that I want to focus on was utilizing this to buy a home. So it was interesting because I have a client who was interested in buying an investment property. The challenge was, in this scenario, is this one individual has a lot of money and he has a lot of assets. He's retired at a fairly young age. So the challenge he was having was not being able to get a mortgage. And I know some people listening to this podcast are probably going to be like, wait, that doesn't really make a lot of sense.
Yeah, I was just going to say that. I'm like, okay.
Todd has a client who has millions of dollars but can't get a mortgage. And that's the truth. Banks are looking for income. When there isn't a steady flow of income, then there are ways we can get loans through the bank, and it's really just asset-based loans. The challenge with those asset-based loans is there's a lot of underwriting involved. The rates tend to be a little bit higher. It becomes a little bit of a challenge, but when you have somebody who has a lot of money, they want to take advantage of an opportunity, and they're saying, well, it doesn't really much make sense for me to pull from one of my other assets that's earning money and buy this other asset. I want to be able to use someone else's money, which is what everybody does where most people do when they buy real estate. So in this case scenario, this client has been working with us for quite some time, And we've incorporated whole life insurance into their lives, and they were doing it at a pretty high level. So we had re-engineered their assets, and they had a lot of cash value inside of the life insurance. So when my client came to me and said, Todd, I found this property, but we're having a little bit of an issue here getting a mortgage, believe it or not, even with all of our assets. What do you recommend we do? He's like, I really want to buy this property. I think that there's a great opportunity for it to appreciate in value. And if in fact I don't use it, it could actually create then additional income for me. And it will most certainly create deductions. It won't be able to depreciate the property if I'm renting it. So I think it's overall a great opportunity. The problem is that I don't know how I could buy it, even though I am wealthy. So my suggestion was why don't we try to utilize the cash values inside the life insurance policy, the whole life insurance policy, to purchase the home. So he said, well, I remember we talked about the flexibility and how we can utilize this vehicle in a lot of different ways. I would be more interested in hearing about this. So I said, well, think about it. You are your own bank right now with the whole life insurance. So let's view yourself as the bank. So there's going to be a cost of borrowing the money from the plan, but the interest rate is pretty much equal to the interest rate that you're going to get out right now from the bank. So we're going to basically borrow from your own bank. And what we're going to do is we're going to amortize it the same way as if we were to amortize it through Bank America or Chase or any other bank. Let me show you how it's going to do. But some of the benefits of doing this is that we'll have the money to you tomorrow with no underwriting. So we can wire the money into your account. You'll have it within 24 to 48 hours. Okay, so now immediately you're going to have more leverage in buying that property because you're going to go be a cash buyer, and there really is no underwriting involved on the back end. Secondly, you're going to go in there and you're not going to have to pay any fees or closing costs. So how much are we going to save there if the property is $1 million? So we're going to save a lot of money on just fees and closing costs. Once the property is purchased, then you're going to hold the note on the property, and then you're going to have a loan inside your life insurance policy, which would be similar to you having a loan with the Bank America. And all we're really going to do is we're going to amortize it however you see fit. So we can amortize it over a 15-year period utilizing this interest rate, the internal interest rate from the insurance company, or we can amortize it over 15 years utilizing another bank and assign the policies as collateral. And that way we might be able to get even a better rate on that. But either way, you're going to have the ability to then figure out how you want to set up the structure of the loan. And all while doing this, you'll be paying yourself back interest and principal based on how you want to structure the mortgage or the loan inside your whole life insurance policy. And all along, the non-guaranteed participating dividends will continue to come in and go towards back into the plan and go towards your net cash value. So overall, that's going to reduce a lot of your lost opportunity costs. So you'll have your mortgage here, a lot less fees, no closing costs. You'll hold the note on the property, and then you'll have those dividends that will be rolling back in. And those dividends will also have options to then help us pay down the loan and shrink the schedule and or just have them rolling back into the net cash value. Either way, it gives you all the options and power on your side. He's like, wow, this sounds amazing. So
that's awesome.
He basically did exactly that. And he took the money out and went in, he bought the home 2 days later for cash, and we structured it that way. So that was, to me, it was a really powerful story to tell because it just shows you that it's not always black and white in regards to what it is you want to do with your money and how you're going to be able to do it. So having a vehicle like this in your life will give you a lot of flexibility. And this was just one specific area to where our clients utilized it. And in this area, it executed perfectly. And he was able to go out and, and buy the property that he wanted, and the rest is history from here.
Yeah, that's great. I mean, that, again, you talked about flexibility, but that's still just baffles my mind that somebody that has enough money to just purchase a property outright, most likely, can't get a loan from a bank because, well, they want too much money from people. So they, again, financial institutions like that, taking advantage of people, in my opinion, it's unfortunate. So yeah, I'm glad to hear that there was a really good solution for him out there.
Yeah, absolutely. And just goes to show, as we're doing this podcast today, the market is gone into a correction mode, and with the coronavirus and things that are happening, and these are things that we don't really have much control over. So I always say to our clients, well, listen, this will come and go, but what's going to really happen in this period of time? Are there things that we're going to need to do? Is something going to happen in your life to which we have to adjust, and how are we going to get through that without kind of letting our financial plan fall off the cliff? So it just goes to show that, this is just one area that, there was one instance where he was having a hard time getting a mortgage, but there might be another instance where someone's looking to get money, but it's just not a great time because the market's down a few thousand points, and it just doesn't make sense to pull from that particular asset.
Yeah, I've never heard of that as far as being able to work with property. So that's a great example. What's the next example?
Well, the next example, which is pretty popular, is the college planning scenario, right? Is that we find all the time that when we sit down with our clients, they have valid concerns about a few things. And one of them is usually how they're going to be able to put their kids through college. And, one of the biggest challenges that we see is that our clients, when they come in, they're not, it doesn't really matter where they're saving, they're just not saving enough. When you look at some of the vehicles that are out there to really save for college, you wonder if there might be some other options available. One of them that is the whole life insurance. So we'll utilize this as a full comprehensive planning tool. And we talked about a gift of a lifetime on the last podcast. So we talk about so many different ways on how you can utilize these vehicles inside of a financial plan. I just explained one in buying a property. The other one is being able to put your kids through school. So I have one client, it's interesting because this client was not a real high earning W-2 employee, did fairly well, was just putting a lot of money. When I met them, their primary savings vehicle was putting money into their 401k plan. I believe they had a small 529 plan set up for the kids where they were putting in maybe $100 a month. So clearly the direction they were heading in was going to be one of which there was going to be really a huge shortage for college when that time came. So we started talking and in the beginning part of the process, and we're really just going big picture and comprehensive about, hey, listen, we need to be making sure that we're saving the right amount of money. Number one. Number two is, where are we saving? And if we continue to put all of our expendable cash flow that's available to us into a vehicle that we can't touch till we're 59 and a half, where does that really leave us in regards to being able to fund college? And they never thought about that. They were like, well, that kind of makes sense. I can't touch it till I'm 59 and a half, but my kids are going to be going to school prior to 59 and a half. And clearly putting in $100 a month per kid into a 529 plan is not going to really get us to where we need to go. So after we re-engineered and we restructured everything and we got them saving the right amount of money and we reallocated quite a bit of cash flow into dividend paying whole life insurance, and it was really built around this gift of a lifetime type of scenario where it was going to be one where it's going to help fund them for college, help fund the kids' college, and then help them supplement retirement needs on the back end outside of their retirement accounts and their real estate. And as you can imagine, when something new is introduced to people, they become a little bit skeptical because this is something that they've not heard of. And they've heard of 529 plans and they heard of 401ks. But this whole life insurance as a gift of a lifetime type of vehicle, one that could be used for college, was something that was new to them. So like I said in the beginning, part of this segment is that they did not make a ton of money, but we were very aggressive in making sure that we recaptured the right amount of their cash flow, and they had to adjust their lifestyle a little bit, and we redeployed it to this area. Fast forwarding probably 8 years, we're having a review, and the client says to me, "It's time now, Todd. My daughter is looking at this school, and just like you said, we have just this little bit in this 529, but we've saved up a lot of money here in this cash value. So can you show me how to utilize this to put my daughter through school just like we designed?" Outside of this, they've never been really disciplined in saving extra money into their savings accounts. It's just sort of human nature. So without this vehicle, it would have been extremely challenging for them to be able to help with the school situation. And most likely what would have happened was they would have had to incur loans. That's really the only scenario that would have been available to them outside of borrowing from their 401k, which probably would not have been the right move. After looking at all of this, so now here we are, and they have quite a bit of money saved up in their whole life insurance and a little bit of money in the 529s. And now it's time to put the daughter through school. So the first segment the first part of this was that we were going to use whatever was saved up in the 529, and we were going to bleed that out first, okay, and continue saving into the life insurance. Okay, but the difference that they needed for this particular year was $16,000. I said, no problem. I said, we're going to send you the $16,000. And I'll never forget this, what they said. They were like, "You're just going to send it to us?" I'm like, "Yeah, should I send it to somebody else?" And they were like, "That easy?" I said, "That easy." They're like, "Okay, so what happens after this, Todd? So you send us the $16,000. We clearly have a lot more money, and we're going to need more money next year, which is fine. But we talked about the gift of a lifetime here, and how do we get this money back in?" I said, "Well, we don't have to put the money back in." I said, "That's one of the great things." I said, "But ultimately, we did talk about this gift of a lifetime scenario, and this is built into your financial plan, so we're going to want to utilize it for other things. So we're going to send you the $16,000, okay, and you're going to pay for college, just like we discussed." Okay, so now interest is going to start to accrue on the $16,000, and it's going to be annualized interest. Okay, so we're going to look at this year by year on the interest. So when the interest comes in, I'm going to want you to pay the interest if you can. I said, "Can you do that?" "Absolutely." Great. Now, we have a lot of different options for getting this money back in. So we can utilize the dividend or a portion of the dividend, and we can redeploy that and change the dividend option to loan repayment. So now you see your dividend here is a couple $1,000s. So if we borrowed $6,000, just utilizing this dividend, if we were going to do dividend loan repayment, and you were just going to pay the reducing interest out of pocket, that this first portion of the college would be paid off in 2.5 years. And they're like, "Wow." And I'm like, so we can do this over and over again in perpetuity, okay, until college is paid off. Now, if in fact we don't want to utilize the dividends and you want to set up just a loan repayment structure, then we could easily do that, and we could identify that, and we could amortize this debt over a very, very long period of time or a very short period of time. I said, "But this is not something that we need to discuss today. Let's just fund the college, and at our next call in 3 months, we'll start talking about the options for how we're going to look to repay this back." So as you can see here is what we made possible here through our comprehensive planning and really managing the income and managing the cash flow and making sure that something like this was coordinated in their plan for a specific reason, that these people who I would put probably any amount of money on it to say that they would have been taking out loans to fund college. Mm-hmm. And so now this is actually executed 100% the way we decided. And we've done this without taking any risk. And that's the thing. So in other vehicles like 529 plans and investment accounts, there's risk. And, so you take more risk on 529s, and then as the kids start getting closer to school, start to reduce the risk. But they can only be used for one purpose. So in this case scenario, it worked out to where the daughter was going to school, and that's how we were going to be utilizing it. But there was no risk associated at all along the way, and they had all the flexibility and options at the time of her actually going to the school to be able to determine what is going to be the proper way of funding.
Yeah, man, that's awesome. And I would say that in these people's scenario, in this example, most likely they would be taking out loans to send, their child to college. I would say that is most people out there, right? I mean, that's what most people's situation is. Most people don't have a 529 plan, or most people don't have a good, solid savings for college. They may have something from grandma and grandpa. Maybe, grandma and grandpa have set aside a couple $1,000s for college, but reality is college isn't a couple $1,000s anymore. So this is a beautiful way to do it. Now, I know that we're getting close to time. Do you have one more example for us that how you can utilize whole life insurance other than the death benefit, which, like I said, most people think about just the death benefit. These are two amazing ways. What other ways can we talk about today real quick?
Sure. I had a few other ones, and I know, we could kind of really get into the weeds about this stuff because there's so many ways that you can actually utilize these plans. But the one I actually wanted to talk about was an interesting one. It was about losing your job.
Really?
And losing income. And because I feel that this, when we look at whole life insurance, we call them self-completing plans. They're going to complete no matter what. They're going to complete if you become disabled. They're going to complete if you pass away. If you lose your job, they're going to be there for you. For us, I wanted to also highlight an example of a client that lost his job and how it really helped him during that period of time to really continue to pay his bills, continue to take care of his kids, put food on the table, keep all the protection in place. And then once he got back on track, it was as if it never happened. So I want to go into that scenario because I feel it's important to understand all the different aspects, not just from utilizing it for a purpose of creating additional wealth, but also for the purpose of what if something happens, how does this react versus some other assets potentially that are in your life, and it's important. So I'll go into that scenario right now if that's okay.
Yeah, absolutely. And I want to say this. I think this is an incredibly important scenario I'm really looking forward to because, again, I've never heard of this strategy before, but you were talking earlier about how the markets are acting volatile right now. The coronavirus, all these different things. When the markets act up, when the markets go down, not saying that they are, not saying that they're going to, but if they do, there's usually some job loss associated with that. So people that maybe think that they're secure right now with their job, their business may need to start downsizing a little bit to reflect what's going on in the market. They may need to cut some corners here and there. And that's when people are getting laid off. And that's when people are losing their jobs or veteran people, employees are being kind of forced out because they can't afford the salaries as much anymore. It's a very real situation. So I'm excited to get into this. Please tell us how that works.
Yeah. I mean, you hit it on the nose. I always tell my clients, in the worst case scenario, how is your existing plan holding up? Period. And what a lot of people don't realize is that if you can't work, you can't fund a 401k plan, you can't save additional money, all these things stop as well. It's crazy because there's a statistic that says, I believe that one of the first things that goes when people run into hard times is the protection components. Because they're looking for ways to save money, so they feel like, okay, well, I can't afford this, so life insurance or whatever, so I'm just going to cancel. But in this case scenario, you have to understand in the whole life scenario, and I'll give you an example of this one client. This one client was doing really, really well, and just like all of our other clients, this became a foundational piece in his financial plan, saving a lot of money, a lot of cash value, a lot of protection. Also had other type of retirement accounts set up and real estate and everything. One day he calls me and he says, I got a little bit of a problem. I said, well, what's that? He says, well, my company's downsizing and I was one of the ones downsized. I said, well, that's not good. He goes, no. I said, I said, he was very good at what he did. And I'm like, I know you're going to bounce back and you're going to be able to get something way better. He goes, I know, Todd. He goes, my biggest concern is this. He goes, my situation. I have mortgages. I have kids. I have all this stuff. And I'm concerned that if, in fact, this goes on for a period of time, that it's gonna put me in a not so great position. I agreed. I said, listen, obviously, if we're not funding and we're burning and our burn rate is going to go higher on our assets and our cash, then it can very well put us in a position. I said, but you have this interesting thing called whole life insurance that I would like us to entertain the idea of utilizing and bridging during this period of time that you're looking for another job to get back on track. So he goes, well, we've talked about this so much. I'd love to hear. So I said, well, you have all this cash value. I said, so obviously, number one is that we want to be able to reduce your costs a little bit on a monthly basis. So your premiums going in, I said, I'm going to show you a way on how to alleviate those premiums for 6 months to a year. He's like, oh, that would be amazing. I said, and I'll show you how to get those back in, and we can do it through loan repayments or we can do it through utilizing the dividend. I said, but I want to give you a little bit of a reprieve right now in regards to not having to burn down other assets. I said, and in regards to the loss of income, I said, I'd like to also utilize the loan feature to borrow from the plan to cover that lost income over a period of time. So I believe that we can go at probably a 6-month clip just to see where we're at and then take another look at it. But we could stop the premiums for 6 months and then we can cover your income loss for 6 months. I said, how does that sound? He goes, wow, it sounds amazing, right?
Yeah.
I said, but your number one job is going to be is just finding a job.
Mm-hmm. Yeah.
And once you do that, then we'll be able to kind of reset. We'll start funding the plan again, and I'll show you how to utilize some of the great features that are inside the dividend, loan repayment, some loan repayment features, and we'll get that money back in, and all I'll have you do is really just pay that reducing interest out of pocket if we can, and we'll pick up right where we left off, and there'll be no lost opportunity costs. But at least to get you through this period of time without starting to burn down some other assets and create other lost opportunity costs and put a lot of pressure, this is the way that we can do it. So we're going to give you the same income. We're going to reduce down the premium. So net, you're actually going to be doing a little bit better for 6 months, give you a little bit of a cushion. And we executed perfectly. And in this case scenario, sure enough, and I never doubted this individual. He has a lot of talent. I knew he was going to get a job rather quickly. Within 3 months, he had a job. So we still kept the same structure for the 6 months, just while he was getting acclimated at the new position. And as soon as he did, we went right back in. We just switched it right back, and then we changed the structure of the dividends for the loan repayment, and that was going to really just take about a year and a half to have the money back in, and I was just going to have him pay some of the interest out of pocket. And that was it. And, and I'll tell you, the feedback I get in situations like this is, to us, this is what planning is. It's never so perfect where it's, we're just going to put our money here and it's going to go up. We have to understand that there are so many different things that can happen in our clients' lives. Mm-hmm. This client is forever grateful. And I'm forever grateful that he was open-minded to let me help him in this capacity. But the idea here is that the situation could have been a lot worse. And there would have been a lot of other things that would have had to suffer during this period of time, which would have caused him stress. And maybe would have put so much stress on him that he would not have been able to go out and get another job in a 3-month period. Mm-hmm. So that was one example that I wanted to highlight, because I think when people are looking at this, you have to look at all the different pieces. So it could be utilized to create other assets, like we talked about. It could be utilized to help put your kid through school. It could be utilized in bad times or unexpected life event times where it comes from like left field and you have no idea how you're going to handle it. A lot of other reasons as well. So just kind of wanted to end up with that.
No, I think that was fantastic. Again, all three of these examples, I knew a little bit about the college savings just because I've heard about it before, but I never knew how it worked. But the other two examples are fantastic. And talk about making your money work for you, right? In an investment situation or even in the college situation, it really is just fantastic. And it's a great resource. So Todd, if somebody wants to reach out to you and says, you know what, man, these, I found myself riveted by this story because that's the situation I'm in. How do they get a hold of you to start this conversation?
As we've discussed in our previous podcast, we could be reached on our office phone in Colts Neck at 732-526-2922. or you can email office@levinefinancial.net, and we'll get back to you in a timely fashion and set up a call.
Fantastic, Todd. Thank you so much for your time again today.
All right. Thank you, Eric. Appreciate it.
You bet. And thank you all for listening to the Utilization of Money podcast with Todd Levine. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Todd comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And again, I've said this before on other podcasts, but this is one you need to share because this will spark ideas in your family and your friends' brains saying, you know what, maybe we could be utilizing our money better. Maybe we can make it work for us, and instead of feeling like we're under the crunch of anything else that demands our time or our money. What a fantastic way to utilize that. Anyway, I've said enough about that. Thanks again for listening today. For everyone at Levine Financial Group, this is Eric Johnson reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Utilization of Money podcast. Click the subscribe button below to be notified when new episodes become available.
Todd Levine, registered representative and financial advisor of Park Avenue Securities, LLC, PAS. Security products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is an indirect, wholly owned subsidiary of Guardian. Levine Financial Group is not an affiliate or subsidiary of PAS or Guardian. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Whole life insurance is intended to provide death benefit protection for an individual's entire life. With payment of the required guarantee premiums, you will receive a guaranteed death benefit and guaranteed cash values inside the policy. Guarantees are based on the claims paying ability of the issuing insurance company. Dividends are not guaranteed and are not declared annually by the issuing insurance company's board of directors. Some whole life policies do not have cash values in the first 2 years of the policy and do not pay a dividend until the policy's third year. Talk to your financial representative and refer to your individual whole life policy illustration for more information. Policy benefits are reduced by any outstanding loans and loan interest. Dividends, if any, are affected by policy loans and loan interests. If the policy lapses or is surrendered, any loans considered a gain in the policy may be subject to ordinary income taxes. If the policy is a modified endowment contract, MEC, loans are treated like withdrawals, but as gained first, subject to ordinary income taxes. If the policy owner is under 59.5, any taxable distribution from the policy may also be subject to a 10% federal tax penalty. 2020-98793, expiration 4/22.